Welcome to our week 5 tax planning. And this week we're going to talk about what a financial planner does as far as tax planning. I might start out by saying, quite honestly, it's not a lot on your part. It isn't where you have to become a tax expert. It's pretty basic material, and we're going to cover some of the items. Our objectives, by the end of the lesson, you should be able to, first of all, describe what is tax planning done by a financial planner. Second, identify items that can be very useful for the client that they may be aware of or they may not be aware. List and make a checklist of your client's ability to use these tactics. Describe each of them, which we'll do on each one separately with separate charts. And define such terms as owning a business, investing in real estate, and the earned income tax credit, all of which are important. Our clients' concerns, and I think it's valid, when they come to a financial planner, they don't just want you to come up with a financial plan that includes investments and insurance and other items you're selling. They also want you to be able to give them advice on their taxes. And I would say, in my experience of over 22 years of being a financial planner on a fee-only basis, most of my clients were willing to pay the taxes per the code. That was not an issue. The problem was they couldn't tell what was required by the code. And we also found that the clients in general wanted tax avoidance, which is useful, lawful use of the code. They wanted to avoid tax evasion where they could be penalized. Now, I had some who wanted to take risk, but quite candidly, between you and I, people who say they want to take risk are generally not willing to take risk. I'm sure you've seen that in the investment field, but it's also true in the tax field. The first time they get called in by the auditors, they panic and blame their tax preparer or their tax advisor. So I tend to encourage the clients to stay in areas that the IRS agrees to. IRS has a lot of ways to save taxes, and just stay with it. If you want to get into the areas that have these complex formulas, etc., that are used to try and save taxes, they're great with the IRS, and you're going to have to go to litigation. And I've seen situations where people have spent $50,000, $60,000 trying to justify their tax position, and quite honestly, the amount at issue was not that large. And finally, we expect the financial planner, as I mentioned before, to provide methods of saving taxes. And why the financial planner? Because there's a difference between tax preparation versus tax planning. I have been doing tax preparation since the late 1950s. Yes, I've done it a long time. And I am very familiar with the tax code, especially in the last 20 years where I specialized in corporate and LLCs. But I know there's a difference between doing taxes and planning for what we need in the future. And that's where a financial planner comes in. Financial planners are designed to give advice on the future. As you give advice on the retirement plan, their estate plan, their risk management plans, etc., we should be talking about what they can do to reduce their taxes. Where the tax preparer is concerned about what happened last year and how that'll fit into that last year's taxes. And quite honestly, it's too late for planning purposes. In fact, several cases I've ran into in my career where people submitted their tax returns, and when they came to me from a financial planning standpoint, I would look at their tax returns and I said, well, I'm looking at your tax return and I'm looking at the chart you made for me, which is the information I asked for, and you haven't taken advantage of some tax loopholes that are valid. And the answer was usually, well, I did TurboTax or some other tax system, and maybe I didn't answer questions right, or I went to a tax preparer who asked me some questions and he filled out the form. And unfortunately, I didn't ask the right questions. And I said, well, think about it. It's your responsibility really to give the information you need to either the computer or the tax preparer. And you can do that until you get it right. And this information we're going to go over here is the items I would point out to tax preparer if you fall into these areas. And we'll discuss that as we go along. Today, many of your clients need to pay by April 15th. In fact, that's most of your clients, if they're individuals. But they don't have enough data till later in the year, maybe 6 months later. And therefore, the more planning we do in advance, the more we can reduce our taxes. And let's face it, if we really do a good job of planning, we will have a pretty good idea what our taxes will be when it comes to submitting the forms in October. Charitable gifts, I would say start off by saying charitable gifts are a great way to reduce taxes, and you can be very beneficial for you. Many of the tax methods used in charitable gifting are of benefit to the donor, probably more than they are the charity. And the one I can think of first of all is the long-term capital assets that are given to a public charity. First of all, you get a donation at fair market value of the assets, and second, you don't pay capital gains tax on the gain. So let's say you bought some Apple stock when it was $20 a share. It split so many times it's probably worth $4,000 equivalent today. Now paying on $20 and it's worth $4,000 because of the stock splits, etc. Quite honestly, is a big tax bill. So instead, you give it to charity, and by giving it to the charity, you get the fair market value, the $4,000 for the $20 investment, and you don't pay any taxes on the difference between the $20 and the $4,000, which is another big advantage. So that is a great way to go. And there's others. Charitable remainder annuity trust and charitable remainder unit trust are two good examples. For older people, I like the pooled interest trust. At, say, someone's 65 or 70 can give a charitable gift that gets an immediate tax deduction and then get, in effect, an annuity for the rest of their life. Foundations are also good, as the benefits can be formed with assets of $500,000. Now, I know the literature talks about you can be as low as $5,000 to form a foundation. Makes sense. But candidly, $500,000 is where the real benefits come in, and people, quite candidly, find that foundations are an excellent way to help yourself. Due to the economy, many of our clients are forced to move to new locations for a job. Some of these expenses are deductible at 50 miles between the old residence and the new job. So let's say you were working in Long Beach and they relocated you up to Amgen in Thousand Oaks. That's over 50 miles. A lot of people don't realize it, that you can take some of those expenses as a tax deduction, and those expenses are covered in your textbook, and you should remind your client of it, have they made a move for business purposes. Also, if your college graduate attained a job at a distance over 50 miles from where you were living. So let's say you're living here on campus at Cal Lutheran in Thousand Oaks, and they move you to Bakersfield, God forbid. Yes, you would be able to take the cost of being relocated to Bakersfield. So there is, and I think a lot of the college students don't realize that, and that can save a lot of expenses. They're low income, so they're not going to pay a lot of taxes anyhow, and by taking these deductions, many times they get out of paying taxes. Job hunting. In today's economy, many took jobs below their skill levels. That's certainly if you graduate any place in the last 7 years, and even today, we have to just get a job. And the job may be what we are able to do in the job skill, but we're able to perform a little bit better in that skill occupation and certainly get more money as the economy grows and there's a bigger demand for your job. So we're looking for jobs, and our clients are obviously looking for jobs. So our clients can take advantage of it. Cost of looking for a new job in the present occupation, again, which is very broad, is a miscellaneous expense. It's got to exceed 2% of AGI, which again, in many cases, is relatively easy, especially if they're getting a little less salary than they expect to receive for that particular field they're in. And this includes fees for outplacement agencies, resume development costs, phone bills, and travel for interviews. Very broadly used. My clients who have used this, because of the fact that, quite honestly, a lot of my clients have, because I've been doing some pro bono work the last few years, have found this a very useful thing, and a lot of expenses they forgot about, we added back in and got a big tax deduction. But job searches by college graduates are not deductible unless you're already in the occupation. So let's say you're an accountant and you're getting a degree that qualifies you for becoming a staff accountant rather than a junior accountant. Yes, that would be fine. Then you would be able to take the deduction. Or let's say you're a financial planner and you're a paraplanner, and you, because you got your degree, now can go for full CFP. There's another example. And the job search may take you not only locally, but entirely different parts of the country. We've had situations where people were students here who moved halfway across the United States, from Texas to the East Coast. That would be deductible when they graduate. Again, as long as they were in the field while they were taking the courses. And I think most of you are working, that would apply to you. So let's say you're stuck in North Dakota and the economy is no longer booming because there's no longer the oil being produced, and you say, I got to get to a new market. And you say, Santa Barbara. It's warm, they got the beach, got good paying clients. That'll pay for it. Child independent care. I think most clients are aware of the child credit. Many are not aware of the child care portion. And they have very few who ever thought of the fact that the child care, independent care, can be used for parents, spouses, and other adults dependent on you. And if two or more dependents, the maximum credit is $2,100 off the tax bill. Well, $2,100 may not sound like much, but if you're in the 25% tax bracket, that's equal to $8,500 deduction. And people will kill for an $8,500 deduction, not realizing the tax credit's equivalent of $2,100. And I think that's another thing I might note at this time, is that you have to explain to your clients the difference between a tax deduction, which are really designed for wealthier people, and a tax credit, which are designed for the middle class and lower class. The expenses for the credit include housekeepers who care for the children under 13 or disabled dependents. So if you have a brother-in-law who broke his hip and he's staying at your house because he's got no other place to stay and you're working, you could qualify. A mortgage refinancing cost. We've had a lot of mortgage problems for people the last 7 years. People who 8 years ago say, I'm never going to have a problem with mortgage. All of a sudden found themselves in problems. The value of the houses dropped, so they were below water. And then there became the refinancing, and we have all of these financing gimmicks out there. I think every person who ever could learn how to spell the word refinancing has gone in the field, and they all have gimmicks, most of them which are questionable. But we do have expenses that we can take for mortgage refinancing, which includes the interest deduction for the refinancing, and that you can pay off your college loans and refurbishing the residence, and maybe pay some of your other expenses, pay off your credit card debts. So your client has a big opportunity here. The interest is deductible. Now, if there's refinancing points, which a lot of our lenders do, they are deductible only if the loan is used to improve the residence. However, quite candidly, I've got clients who are paying 15, 23% interest. I believe Discover is the one with the 23% interest. And they can refinance the house because they've got a big equity in it and pay 3.5%. In fact, I just refinanced the rental for 4.5% interest, which if I needed money, that's a lot better than any credit card interest. So I can integrate my debts, and that's the same thing everybody can do. That's a big advantage of home ownership.